I'm Nicole Rachat with the Investing News Network, and I'm here on day 2 of Minds and Money New York. And joining me today is Adam Rozencwajg, Managing Director of Goehring and Rozencwajg Associates. How are you today?
I'm very well. Thanks for having me today.
Thank you for joining us. So I'm going to jump right in, and I just kind of wanted to know what does investor sentiment seem to be around the resource space right now?
Well, I can never remember investor sentiment being so negative towards resource stocks in general, both on the mining side and on the energy side. We look at data going all the way back 100 years, and we look at the price of commodities relative to the price of the Dow Jones or the S&P, and on both cases, you're at a 100-year low. Um, Moreover, if you look at the commodity stocks over that time, you're also approaching a new low. So you're certainly at the bottom of the cycle. Investor sentiment is really as bad as I've ever seen it. Um, just the other day, you know, the weighting in the S&P of both the materials and the energy sector hit new lows. And what's really interesting, I think, is that there's a really big catalyst that just occurred last week for investors that are considering whether or not they want to actually add exposure to the space. And that is that Business Week, Bloomberg Business Week now published a cover story calling for the death of inflation. And the last time that they published such a authoritative and such a definitive cover story was back in 1979 when they called for the death of equities. And that was within 2 years of the bottom in the equity market. And from then on, stocks have gone on to basically be in the biggest bull market of all time. And so I think you're getting a similar contrary indicator today. At the very least, I think it's a sure sign of where the consensus opinion is, and that is that inflation has been slayed, it's over, and that there's no real need for hard assets in a portfolio. And I think exactly the opposite is true.
Okay. And since we're talking about portfolios, what do you have any advice on how investors should allocate their portfolios across the resource space?
Well, again, getting back to that cover story, if we think that the um, age of inflationary expectations is now about to shift and we're going to enter a period of ever increasing inflation over the next decade or so, then really investors need to have some sort of an allocation to hard assets and to resource related stocks in order to help protect against that. Back in the 1970s, resource stocks were really the only place to be from 1969 to 1980. The stock market was largely flat and resource stocks did incredibly well, and they help to protect against some of those inflationary expectations. And I think that we're entering that same period again. At the same time, like I mentioned, all of the indices, whether it be the S&P or the Russell, have an all-time low weighting in commodity-related stocks. And so for those people who have piled into passive investing in index funds, they've never had less exposure. And I think that that's potentially a big problem. So I think that allocating really to the space in general is probably the right decision right now. Um, and in particular, energy securities have really underperformed over the last 3 to 4 years, and I think the fundamentals look incredibly strong.
Okay, great. In terms of jurisdictions, are there any jurisdictions that resource investors should keep an eye on?
Well, it really, I suppose, depends by commodity. In the energy sector right now, really what's taking place here in the United States in the shale, it's really the only bright spot in the global crude oil markets. If you look at the non-OPEC crude oil supply outside of the U.S. shales, it's really been under pretty severe decline over the last year in particular. We think that's going to continue going forward. But the U.S. is a bit of a bright spot, particularly in West Texas and in the Permian Basin. So we like that. On the copper side of things, my partner Lee and I are actually on our way to the Congo to visit with some development stories there that I think are very, very exciting. And on the gold side of things, certainly some of the results coming out of West Africa are very, very encouraging as well. So I think it really depends on the commodity.
Okay, great. So focusing on copper for a second, um, where do you think that we are in the resource cycle right now? Do you believe that copper will reach $10 a pound in 2019?
I think that $10 a pound in 2019 is probably a little bit high, but we are very, very bullish on the copper market. We think that there's a sustained rally here, and I think it could take it to $10 a pound sometime in this cycle. 2019 seems aggressive even by our standards, but really what's driving copper going forward is going to be copper demand. And it's going to come from several different sources. And I think that people don't fully appreciate really how strong this demand surge is going to be. One of the sources is going to be China, and the reason I say that's controversial is because most people believe that China has overconsumed copper in the last decade or so, and that it's only a matter of time before that hits a wall and begins to slow dramatically. We think just the opposite, and we think that the big distinction that people need to look at is not the annual consumption of copper, but rather how much total copper has been installed in an economy. And it turns out that if you look back over a long period of time, many countries, many different eras, based on where real per capita GDP is, that economy ought to have a certain amount of copper installed in the system, and things like electrical grids and other infrastructure sources. So based on where China is today, has exactly the right amount of copper installed. It has not been over consuming according to our models. So as China grows, we think demand will grow too. India, on the other hand, is woefully behind where it ought to be. And in fact, we think if it were to catch up to where it should be based on its per capita GDP today, that would add a huge incremental source of copper demand over the next decade.
Okay. And my final question for you is, what is your opinion on the electric car story, and how do you see it affecting copper, if at all?
Well, we've written in the past that we think that there's substantial problems with the electric vehicle. And so while it will continue to grow and while the demand for it is there as what we like to call a plaything for the wealthy, I think the ability of electric vehicles to really displace internal combustion engines on a broad basis will be fairly limited. And the reason for that is that quite simply, it's not the best tool for the job at hand, meaning the amount of energy it requires to both manufacture a car, a battery, and then power somebody to move a given distance is substantially higher in an electric vehicle than it is in an internal combustion engine. It's more efficient once the energy gets put into the car, but the actual energy to manufacture the battery in particular is very, very difficult. It's very high, and we see it unlikely to decline to a point where it'll be competitive with internal combustion engines. So we've written about this, and I'd encourage people to learn more. We've written in our quarterly letters available on our website if they want to learn more about that. Where I do think that copper is going to have a big impact going forward is going to be in renewable electricity in general. People don't fully appreciate that to generate electricity via either solar or wind, it's anywhere between 30 to 40 times as copper intensive as traditional coal or natural gas fired plants. And we have an example of that now where we can actually look empirically and see whether or not that's true. And that is what's happened to copper demand in Germany, Spain, and Italy over the last decade compared with the rest of the OECD world. And you can see a huge divergence where all three of those countries that have pushed large renewable mandates, their copper demand is actually flat to slightly up, whereas the rest of the OECD world has seen their copper demand come down substantially as higher prices have bid that material into the emerging markets. So that's all consistent with renewable power being 30 to 40 times as copper intensive as traditional forms of electricity. And to the extent that that continues to be a trend going forward, I think that's really going to drive copper demand.
Okay, great. Well, thank you so much for joining me today. I really appreciate it, Adam. And I hope you enjoy the rest of your day. And once again, I'm Nicole Rachat with the Investing News Network, and I'm here at day 2 of Minds and Money New York.